What's up, visionaries? I want to start this video with getting straight to it, and I want you to see this right here. This is Fox Business News mirroring saying he's looking at over 100 basis points of rate cuts in 2026. Check it out.
I think we've got to cut more than 100 basis points this year.
Okay.
I mean, look, measured underlying inflation, once you adjust it for quirks like the housing thing I was describing before, once you adjust it for quirks like the portfolio management services contributing 25 basis points to core PCE inflation, despite, continual cuts in fees that are actually charged to investors. Once you adjust it for those things, underlying inflation is running within noise of our target. I gave a speech about this about a month ago at Columbia University. And so underlying inflation is already running reasonably close to our target. The unemployment rate has been very gradually and slowly creeping up. I think it's very difficult to argue that policy is about neutral. I think policy is clearly restrictive in holding the economy back. And with underlying inflation basically within noise of our target, I think that, well over 100 basis points of cuts are going to be justified this year.
So Governor,
We're barely a week into 2026, and the conversation has already started. And I need you to understand something very clearly. This is not new information. This is confirmation. Because this is the exact narrative that I was talking about last year. You don't position after the news hits, you position before it becomes consensus. Then you exit and take profits when the narrative rolls over and dies. That's why you want to be walking out while everyone else is walking in. Now, layer this with what happened right after that clip. You've got Trump back on social media, jawboning the Fed, talking about fixing the economy, hinting at control independence by foot.
And now he's got us in a bad place. So we're paying $360 billion a year for each point. Now, I believe we should be 3 or 4 points lower. So that's over $1 trillion we pay every year in interest. And it's really just a paper calculation. You sign a document and you save almost $1 trillion.
This isn't noise. This is pressure. So let me show you the chessboard, because most people are staring at the clock instead. So you've got Powell sitting at the Fed, yelling in the background, Trump moving the king across the board. Whether you like him or hate him is irrelevant. See, what matters most is leverage, and leverage changes behavior. Here's where I need you to zoom out and really pay attention. This is where the Cantillon effect comes in. I've been saying this for years, and I'm going to keep repeating it until it clicks. When new money enters the system, it does not hit everyone at the same time. It never has, and it never will. Here's the chain, simple and clean. Rates get cut, bond prices move, liquidity flows, and that liquidity hits banks first. Then asset managers, then hedge funds, then asset markets like stocks, crypto, and real estate. It goes to the business owners and asset holders first. And only after all that does Main Street feel any of it at all. Wages do not spike overnight. Rent doesn't drop, and groceries are not going to get any cheaper. This is not a conspiracy. This is the mechanics of how our economy operates. See, after the 2008 rate cuts, the top 5% of net worth households saw gains north of 30%, while median households' wealth barely moved. This is the same playbook in a different year. As they say, history doesn't repeat, but it damn sure rhymes. So when you hear rate cuts, stop thinking relief, start thinking of who benefits first. This is why I keep telling you, know the market is volatile, it is a strength. If you do not understand where liquidity flows, you'll always feel late, confused, and unlucky, and that's by design. Now, let's talk about positioning, because that's the only thing that matters. I'm not here to tell you what to buy. I'm here to tell you how to think. See, if you're sitting in cash, you are not safe. You're just exposed to dilution. If you're over leveraged in stocks, you might want to lighten up into strength, not chasing headlines. I know that's really hard for a lot of you. But if you're watching real estate, pay attention to only One thing: the spread between Treasury yields and mortgage rates. See, that's where opportunity hides when cuts actually materialize. And if you're in crypto, this is where people mess up the most. It's a risk-on asset class. They wait for the announcement, you wait for the confirmation, and then you wait for the price to move. By that time, everyone agrees the easy money is gone and you're left holding the bag. See, Trump jawboning the Fed isn't entertainment, it's signaling. Powell saying he decided the rates while swallowing hard isn't really confidence, it's tension. And tension moves markets. See, too many of you are trying to predict the future. You don't need to predict the future. You need to recognize patterns. The Cantillon effect isn't theory, it's a map. So here's the real question that I'll leave you with. Are you positioning like someone who understands the board, or are you waiting like a pawn, hoping that the game works out for you? Because, see, the conversation has already started, and it's still the same narrative. The pieces are already moving, and the exit are always quieter than the entrances. So, visionaries, I'll see you in the next one, but I want you to ask yourself this one question before you go away. Are you actively playing the game, or are you passively being exit liquidity, waiting for more proof? If you like this type of content, subscribe, like, and share this with someone, and let me know what you think I got wrong or what your opinion may be. See you on the next one.